Hello, this is Joe Zappia from LVW Advisors. I'm here with the CEO and founder of LVW, Lori Van Duzen, and today is July 25th, 2023, and we're here with our State of the Markets webinar. Hello, Lori.
Hi, Joe.
Before we get started, I'd like to just take a second and review some important reminders that anything that Lori and I talk about in today's webinar should not be considered investment advice or recommendation to buy or sell securities. If we do speak about specific securities, LVW clients may or may not own these securities. And if you have any further questions, we encourage you to reach out to us. But today's webinar is for informational purposes only. So let's talk a little bit about where we are year to date with the markets. The first half of 2023, the overall markets are off to a great start. World markets are up, the S&P is up, the NASDAQ's up a lot. Pretty broad rally, but lots of dispersion.
Yeah, it's remarkable considering going into this year, there was so much pessimism, and there was this thought that the 60-40 indexing in bonds and stocks was dead. And if you look at the S&P 500, the cap weighted index, up 15.9 year to date, and you look at the even weight S&P, you can see this disparity. In fact, it's the widest performance disparity so far year to date in history. And obviously the NASDAQ is been driven a lot by the same kinds of companies, large mega cap tech.
Yeah, absolutely. And I think maybe I could just take a second and explain that the S&P 500 index, which is the broad index, is capitalization weighted. So that means a company like Apple, which is the largest company, may represent 6 or 7% of that index, and the other 499 companies are something less than that. Whereas the equal weight index weights each of the 500 companies equally. So it's a better view of what the broad index or the broad economy is doing, in my view.
Correct. Yeah, I think that's right.
So let's talk a little bit about the story of the second quarter. And to me, I think that the story, well, there's a couple of things, but the bullish story, or the reason why markets are doing well, in my view, is that inflation's coming down, and it's probably coming down faster than most people thought. And we are now at the lowest levels, using the two major inflation readings at the lowest level since October of 21. So while inflation is still above the Fed's target of 2%, it's much more in line with headline CPI coming in a little bit under 3%, and core CPI being under 5%.
And the producer price index, the PPI, actually printed recently, I think, 0.1%, looking deflationary, and that is a leading indicator. So I would be a little bit concerned about that.
Yeah, well, there's no doubt that inflation is coming down. One of the things that we talk about in the investment committee is at what point does lower inflation move from being a headwind to the economy and a tailwind? And this could explain, and we'll talk about this more, but this could explain why markets are a little bit more optimistic, at least on companies, because if input prices are coming down, but those companies don't have to cut prices yet, it means better earnings and better margins. And we'll talk a little bit more about that later. So how is the inflation coming down beyond the base effects of some of the distortions from COVID? It's mostly a result of Federal Reserve policy, where the Fed has gone from raising interest rates from 0% to 5% over a course of a little more than a year. And that's led to, and this is the next chart, that's led to the most inverted yield curve since 1980. So before you comment, Lori, I'll just say that when we talk about an inverted yield curve, it's a comparison of yields for the 2-year Treasury compared to the 10-year Treasury. In a normal yield curve, a 10-year Treasury would yield more than the 2-year. Today, the 2-year Treasury yields close to 5%, and the 10-year Treasury yields somewhere in the high 3s, or it's about a 1% spread, making it the most inverted since 1980.
Yeah, it's, the whole idea of this, of course, is for the Fed, by raising short-term interest rates, to slow down the economy and slow down consumption. And yet there's this whole narrative, since inflation has fallen pretty quickly, there's this in the last year, there's this whole narrative around soft landing, which everyone is buying into. And I'm not saying they're wrong. I'm saying it's possible for sure. But for anyone who thinks that the business cycle has magically changed, this inversion, seeing this kind of inversion, has 100% of the time, no less than 100% of the time, led to a recession, which makes sense when you think about what it's all about. Short-term rates, borrowing costs going up, slowing consumption. And if the Fed were to just hold here, there's a lot of tightening that has taken place. So will this indicator be wrong this time, or will we look back and say we were just in this kind of rolling recession? I don't know. But
That's
history
right.
is on the side of there being some kind of at least mild recession coming up.
Yeah, and you know, if we think back to August of last year at the Jackson Hole speech, Fed Chair Powell actually talked about recession being in the cards most likely in order to, you know, get inflation in check. So I don't think it would be a surprise to anybody. I think that our view is what's unknowable is the severity of the recession. If it's just a mild earnings recession, the economy can certainly withstand it, as can the stock market. But if there's some sort of misstep or over tightening or exogenous shock, I think it leaves us more vulnerable.
And there's things out there in the horizon that you have to kind of factor in, like all of the commercial real estate issues, for example, and debt terming out and having to be restructured, the amount of that into higher yields, even if the Fed stopped today. So, I think we can be constructive but cautious on our view.
Absolutely. So this chart shows the 10-year treasury going all the way back to the 1800s. And the point of this chart is just to show that effectively the return that you earn on a 10-year treasury is basically your starting yield. And over the last 10 years, had you invested in a 10-year treasury a decade ago, your return was 1.3% a year. And today, the 10-year treasury yields about 3.6%. So that's a significantly better yield for the fixed income piece of people's portfolios. And to your point earlier, Lori, about conversations about the 60-40 portfolio being dead, one of the things I would say is that the 40% part is now actually earning pretty significant yields, and in fact, almost real yields, because if the CPI is now a little bit under 3 and you're picking up 3.5% on a 10-year, that's a positive return for investors.
Yeah, and I think that the real the real important part is real, not nominal return. So where inflation kind of settles out is the most important thing here. And I think the other thing that we've had internal discussions about and have done in terms of our investment committee is looking at cash and the belly of the curve, so to speak, or the shorter duration kind of treasuries, for example, which we don't really show on this chart, but it does make sense if you have such an inverted yield curve right now. And if 100% of the time historically, and I'm not making a prediction, I'm stating that 100% of the time it's led to an inverted yield curve like this has led to recession, then it probably makes sense for investors who have an abundance of cash, not for spending, but just out of caution, to move out a little bit on the curve. Maybe not to 10 years, but maybe to 2 years or a little bit beyond. So that would be, one judgment call based on what we see going on.
Yeah, absolutely. All right, so let's shift here and talk a little bit about the stock market. So we've had quite a rally. This chart's from Fidelity. The S&P's up about 18% year to date. It's up 27% from the low of October 12th, 2022. And it's about 5% below its all-time high, which goes all the way back to January 3rd of 2022. So what's interesting when you look at this chart is we sort of zoom in and look at a more specific period, which shows that over this period, although the market's had a big recovery, really from April of 22, which is a little more than a year ago, through now, markets have really been directionless. We've had lots of rallies, lots of sell-ups, but markets have effectively gone nowhere.
I think this chart is so interesting because I don't think most people know this because we've had kind of this roller coaster ride of, well, we had these significant declines of everything last year. And then into this year, a rally of everything at the top of the market, especially in March when NVIDIA announced their earnings, which we'll talk about. But really, it's a lot of noise when you kind of look at a chart like this.
Yeah, there's no question. So it's a lot of volatility and really no real compounding of wealth. So I did skip over a chart that I want to go back to for a second, and this speaks to what we talked about earlier, and we'll talk about it more now. So year to date, the Nasdaq is up roughly 40%. The S&P 500 is up roughly 19%. The equal weight S&P and the Russell 2000, which is the index of small companies. So the equal weight and the small cap indexes are down up significantly less than the cap weighted indexes in the Nasdaq. And this is almost entirely explained by just a handful of large companies, most of which are tech companies.
Yes, the Magnificent Seven plus AI.
Yeah, there you go. So this is sort of an interesting chart that I pulled from a blog, and I think it's great. At the beginning of every year, Wall Street analysts, top-down strategists are forced to predict where they think markets will be at the end of the year. So this is a list of most of the major banks, and it's pretty safe to say that nobody got this right. No Wall Street strategists really predicted that markets would be where they are today. The S&P closed at basically 4,500. You can see the most pessimistic analysts started the year, predicting that the market would end the year somewhere around 3,600 on the S&P, and the most optimistic analysts, the number was 4,500. At the halfway point, they're very wrong, but who knows what the rest of the year will bring.
Yeah, I mean, I think that's key. That's a key statement. This is the halfway point, or we're into July, and we've had a market where, a handful of stocks have really moved everything and made a huge difference. Most stocks in the S&P 500, for example, have been positive, in general, but not to the degree of these 7 names, and anything that, is very tech heavy in AI. So I think, we'll have to see what the rest of the year brings. And as you know, historically, the fall is not the best time of the year for stock markets. So we'll have to revisit all of these targets at the end of the year.
Yep, absolutely. Let's talk a little bit more about the concentration in the market. So the 5 largest companies in the S&P 500 make up 24% of the index. This is the most concentrated market going all the way back to the early 1970s. And those 5 companies are Apple, Microsoft, Alphabet, which is Google, Amazon, and the new top 5 is NVIDIA.
Mm-hmm. Right.
So just how big are these companies? We've got 2 charts in here that are in here for fun. So Apple's market cap is actually greater than, or just about the same as, all of the Russell 2000 stocks added together.
So the small cap index. So Apple's market cap is bigger than the entire small cap index of companies.
That's right.
2,000 companies. Yeah, it's pretty amazing.
It's an amazing company, but it does speak to just how big it's gotten. And I think that the logical question is you've got a company approaching $3 trillion in market cap. I mean, I thought $1 trillion market cap was impossible just a few years ago. But when you think ahead, you say, okay, in order to really compound your wealth in Apple over the next decade, Apple's going to need to go from a $3 trillion to a $6 trillion company. And the law of large numbers here needs to come into play at some point. So while it's a great company, we're much more interested in talking about some of the smaller companies that seem to, be more reasonably valued. Another chart that we have, and Lori, maybe you can comment on this one.
Yeah. So JP Morgan's market cap is bigger than all of the S&P regional banks' market capitalization together. So that speaks to a lot of things. It speaks to, nothing, JP Morgan's a great bank, and I'm a fan of Jamie Dimon, but I think this speaks to how tough it may be going forward for small to mid-sized companies to get loans. It may speak to private credit filling the gap for some of these regional banks. It speaks to a lot of things, but I thought this was kind of shocking as well as the Apple chart, so we included it in here.
Yeah, and I actually really appreciate your comments about this chart because it really is the nuances when you think about, 80% of commercial real estate loans are made by small and regional banks. And the business owners we have, they don't go to JP Morgan to get small business loans. They go
No.
to the local and regional banks. So something's going to have to shift in the banking system in order for there to be credit creation for small businesses and small companies.
Exactly.
Another chart that just talks about valuations in the market. Maybe we're overdoing this, but it really is a pretty special time. So this is a chart that breaks down the S&P 500 by market cap and weight. And basically the top 10 stocks in the S&P 500 make up 31% of the index, and they're trading at 30 times earnings. What's interesting about this chart is when you work from the 11 to 50, 51 to 100, in other words, the next 490 companies, you can see that at least on a price to earnings basis, the rest of the market is significantly cheaper than the 10 largest companies. And I think it's important when we talk about the market's PE multiple that these 10 largest companies are a third of the index and really distorting that valuation metric.
Yeah, for sure. And well, if you look at all these segments, none of them are considered really, really cheap. There's a big difference between 31 and a half times and 14 times.
That's right. So let's talk a little bit about earnings. One of the things that we have mentioned in the last couple webinars that we've done is that markets are very forward-looking. In fact, maybe one of the best discounting mechanisms. And so the chart we showed earlier showed that the market's gone largely nowhere with some volatility since April of 22, so like 15 months. That actually correlates with the past 4 quarters of earnings generated by the 500 largest companies. We've had 4, including this quarter, 4 quarters in a row of declining earnings. And it's not a coincidence that stocks have largely gone nowhere over that same period. Looking forward.
Not to interrupt, but I just want to make sure that our audience sees this as I see it now, because you put these charts together and they're great. The previous chart where we showed earnings basically going nowhere from April 22. And if you look at this chart and you overlay them, if you were to do that, it's exactly what you're saying. So Q2 22, third quarter 22, fourth quarter, we've had earnings, being revised downward.
Yeah, that's right. So the S&P had its highest. The 500 companies added together had the highest earnings in the second quarter of 2022 at $56.70, and they've been declining ever since. Analyst estimates are that by the fourth quarter of this year, we will have new peak earnings of $57.71. And I think it's safe to say, Lori, that you and I doubt that number will come through that high. But bottoms up analysts at this point appear pretty optimistic. And I think that sort of explains why markets are all of a sudden acting much better.
Yeah. And broadening out a little bit.
Absolutely. Yeah. This is just the same thing shown a different way, that markets move ahead of earnings. So the market peaked in January of 22 when earnings were still growing. The market bottomed out long before earnings started declining. And I think it just speaks to the idea that the market moves ahead of things. And one thing probably worth noting is the most recent rally in the market, this broadening out to more industrials and cyclical and financial type names over the past month or so. Is this a precursor for market participants believing that if we do have a recession, it will be mild and that the soft landing is possible? I think time will tell, right?
Time will tell.
One thing we know for sure, though, is that great companies come out of recession stronger. And it makes perfect sense if you think about it, because when times get difficult, companies tighten up their bootstraps, cut costs, focus on margins, may even do some layoffs, et cetera. And that creates significant positive operating leverages leverage for these well-run companies when they come out of come out of this earnings trough. So what this chart shows is after earnings bottom, typically companies come back much stronger than the previous decline, and this rings true every cycle going all the way back to 1950.
Yeah, I like this chart because it kind of speaks to going underneath the hood and understanding what you own and fundamentals. Because if we are in a recession or going into one, or even if we're having a soft landing or no recession, this matters. The fact that investing in strong companies that can take market share when things are difficult. So maybe we're not going to ring the bell and call this a recession. But it is true that credit conditions for small and mid-sized companies, all companies, have tightened. It's more expensive to service debt, and so strong competitors, will take market share, and those with financial strength will innovate. I think there's a lot of optimism around innovation right now, but they'll also do strategic acquisitions. Some of the best occur during recessions or in times like these. So I think that's basically what it's saying.
Yeah, absolutely. Your point about acquisitions, a lot of it goes on under the scene and largely unnoticed. Companies like Microsoft, they might acquire 10 or 15 small businesses every year that help them improve their technology. So you just don't see it in the headlines when companies make these small acquisitions, but that's why these great companies come out of these periods stronger as well.
Mm-hmm. Yeah.
So let's talk a little bit about what's going on around the world. This is a chart that shows the Citi Economic Surprise Index, which is just simply a line that shows a trend of when economic data releases exceed what was estimated by economists. And more recently, really since May, which sort of again correlates with the move up in the U.S. markets, the economic surprises have been more to the positive side for U.S. markets, and it's been the opposite for the global economy. And a lot of that I think has to do with some of the negative economic surprises that have come out of China in particular, at least up until last week. And this I think speaks to why U.S. markets are once again, outperforming international counterparts.
Yeah, just as recently as this week with data out of Europe. But, we've had this kind of employment situation here, a huge amount of money that has, by our government, that's been placed in consumers' hands. Too much money, it arguably created all this demand. And that has created kind of a distorted environment. But this chart does kind of speak to the U.S. kind of outperforming economically. Remember, we're a consumption-led economy. And if there are cracks in from the consumer's point of view, the economy cracks. And what I think is interesting is this week, I think American Express reported their earnings and they beat, but the stock dropped because they guided lower. And that's interesting to me, Joe, because American Express is known as more of the kind of marquee card or the, kind of top end of the consumer, but they guided lower and they're more cautionary about consumer spending. So this is another one of those charts where there's another layer to it in my mind where we'll see if it's a soft landing or a mild recession or something more. We don't know.
Absolutely. I think that's the key. We do not know. One thing that we did want to comment on was what's going on with the dollar. And the dollar over the past, 10 or 11 years, first of all, the dollar tends to move in long cycles. Mm-hmm. So this chart goes all the way back to 1970, and there's just a handful of long cycles that the dollar has experienced. And for about 11-year period, the dollar appreciated by 42% from 2011, and perhaps it peaked in October. And over that period, the U.S. outperformed the EFA, which would be the Developed International Index, non-U.S. developed companies, by 233%. And we have this chart in here just to say that, if this dollar trend, if we have a new cycle starting with the dollar, it could finally be the catalyst that non-U.S. equity markets need to begin performing better on a relative basis.
Yeah, it's a good point that the cycles are long. Have no idea whether this is the start of a new cycle for the dollar, but if the dollar is in a weakening cycle, yes, it would both, and that would coincide with the recession thinking. And again, we're not calling for recession because no one really knows, but it certainly seems to me that we probably will see some form of a slowdown, and that could lead to a weakening dollar, and it could bode well for stocks, bonds outside of the US, emerging market, debt, and equity. So it's something
Right.
that we're looking at closely.
Yeah, and it also, yes, and it also bodes well for US companies that are big exporters.
Exactly.
Which
Mm-hmm.
is really our tech industry.
Mm-hmm. Right.
All right, fine. Let's wrap it up. So we
Okay.
covered a lot of ground. We tried to put our final thoughts on this page, and I don't know, Lori, if you want to walk through these, or we can go back and forth.
Yeah, we can go back and forth, but why don't you take the first one?
Sure. So what we've talked about a lot is, again, that we think markets move way faster than people realize, and definitely are better predictors of the future than certainly Wall Street strategists. And right now, the bottom that's in place, we don't know if it is the bottom for this cycle, but the bottom that's in place is October 22. And we know that markets typically bottom before a trough in earnings, which is typically 6 to 9 months after the market bottoms. Well, it's no coincidence that we're seeing what may end up being trough earnings this quarter. And markets saw that coming as they began their decline in October.
And then, inflation is moderating faster than expected. And we've had decelerating prices for energy, which, by the way, is a wild card here, especially depending on what the dollar does. Rents, used car, airfares, medical care. So the inflation comparisons vis-a-vis last year look very favorable. So it's led to this soft landing narrative all over the place. And is it possible? Of course it is. So
the first half of the year was led by the big mega cap tech stocks. Some people are concerned about the large concentration of returns coming from just a handful of companies. But if you look back in history, this sort of concentrated market typically resolves itself by broadening out in a positive way, meaning that the big tech stocks stop going up as much as they have, or maybe even decline. And then other companies, smaller companies in the index, begin to take over. And we're starting to see this broadening out. It really started over the past couple of weeks, where the broader market's starting to act a little bit better. And I feel like that has to happen for this rally to continue. If the market doesn't broaden out, I feel like the market doesn't have a lot more upside to it, given what it's being led by these large tech stocks. And
right. Right. And outside of the large tech stocks, when you look at the U.S. stock market, large cap market, as represented by the S&P, it's not that expensive. And in fact, it's somewhat reasonably priced. So I think this speaks to why it's important to understand fundamentals and those companies that if we are in a difficult period, it's certainly in terms of where interest rates are and debt, et cetera. It's really important to understand the companies, their competitive position, their cash flows, et cetera, because this could be the best stock picking environment where you can go beyond those 7 stocks and really make money on companies for the long term. So it's not that we weren't negative going into this year. We were cautious. We did not underweight stocks. We've just I think we're kind of almost in the same place as we were at the beginning of the year. Although the one thing that is really clear is that we're closer to the end of Fed tightening. I mean, that's kind of an obvious statement, but we're closer to the end. And I think at the beginning of the year, in fairness to all the Wall Street analysts and to everybody that does this for a living, it's a really difficult environment. It was really difficult to call where inflation was going to end up. And I think we've had some good news around inflation this year. And that is why the market is a little bit more constructive and things are broadening out beyond these mega cap stock names. So
yeah, and it's for those reasons that we have the next bullet point in there, and that it's really not a time to be overly bearish. The price action of the market, the economic data is encouraging, and positioning is pretty constructive. That doesn't mean we're adding to equity right here. To Lori's point, and I think there's a lot of things that can certainly go wrong. There's a lot of unknowns, but it does not pay at this point to be overly bearish because, as you say, Lori, never fight the Fed, and you shouldn't fight the Fed when they're cutting rates. You shouldn't fight the Fed when they're raising rates. And if they're done now, then the Fed will more than likely be the market's friend.
right. And having said that, though, Joe, they could stay here for a while. In terms of where interest rates are, and that has implications. And so we talked a little bit about dollar weakness, whether or not that continues. That could bode well for non-US stocks and debt outside of the United States. And we're looking at that. While, if you look at investors' portfolios kind of, across the board, generally they have more cash than usual. It may be time to extend maturities to what we call the belly of the curve, or extend out a couple years beyond cash that's needed. That's important. And I think, what's not on this slide is there are a lot of other opportunities that are being created. And I've mentioned this before, but it seems to me that this is a cycle where private credit, because of the banking situation, opportunistic credit, and possibly distressed investing might be in a longer cycle than previously. So we are looking at all kinds of opportunities around credit. And so, I would just say, again, this isn't a recommendation. If anyone listening wants to talk about that, please feel free to give us a call about anything that we said on this session. We're happy to talk with you.
As always, yes. And
Yeah.
that's a wrap. That's a wrap.
Okay.
So,
Correct.
Lori, thanks for your comments. I appreciate the dialogue, and we look forward to everybody enjoying this webcast. Please send us feedback and comments and questions. We look forward to hearing from you.
Absolutely. Thanks, Joe.
Thank you.